Hi there. Do you want to know where and how to find a safe haven during troubled times? Adam Gower here, and in today's podcast, that is exactly what you're going to learn about with my guest, Joel Friedland, principal at industrial real estate firm Brit Properties in Chicago. I've been working with Joel for some time now, and you are going to discover everything you needed to know about Class B and C industrial buildings. Joel's pragmatic approach to debt and risk are the foundation upon which he's built his success, and the industrial niche he operates in has not yet experienced the worst effects of the current downturn. What you're going to learn about is how he's shielding his portfolio from the worst ravages of inflation, rising interest rates, and general economic slowdowns to protect his investors' capital while continuing to deliver solid, predictable returns. Find out more about Joel and Brit Properties. Go to the podcast page at gowercrowd.com, and while you're there, be sure that you click on the subscribe button at the top of the page to gain access to our free weekly newsletter. It's the only one on the web exclusively dedicated to real estate crowdfunding and syndication news and updates, where you'll get information and resources you can use immediately. Subscribe there at gowercrowd.com. It is totally free. All right, now over to Joel Friedland, principal at industrial real estate company Brit Properties.
Joel, it's always such a pleasure to see you. Thanks so much for joining me today. So we started chatting a little bit before the cameras rolled about marketing, and you were telling me about videos that you've been producing. Why don't we start, actually, I've come to think of it, why don't you tell me a little bit about what you do, what is your business model, what kind of investing do you do, and then we'll talk about how you've started marketing, and we'll get onto those videos. But start by telling me a bit of your background.
Sure. So I am an industrial real estate syndicator in Chicago. My entire focus is buying small, and I say small, under 50,000 square feet generally, industrial buildings, primarily occupied by manufacturers that would be classified as B and C. The buildings are a little bit older than these new precast gigantic warehouses that are occupied by Amazon and Target. Our tenants generally are 10 million in revenue up to maybe 50 million in revenue. And then we have a number of national and international tenants as well. Our main focus is cash flow, passive income, in the safest way possible, which to me simply means keeping my debt to a minimum. I believe that leverage is the reason for every bad deal I've ever made. And anyone I know that's gotten in financial trouble as a real estate syndicator, it was because they owed the bank too much. They couldn't handle the turbulence when it occurred.
Well, that's what makes today particularly interesting time as we see interest rates climbing as fast as they are, and the impact that's going to have on commercial real estate. So let's talk about that as well in a minute. I am taking notes about all these things that we're going to be talking about. But to start with, when you talk about your tenants, right, so you have low debt, which allows you to sleep at night. But this, the economic downturn, these recessionary downturn that we're either in or heading into, combined with increasing interest rates, not just for real estate, but also for business borrowing, et cetera, et cetera. Is that having any softening impact on tenant activity in these B and C class industrial properties, not just that you own, but in the industry in general?
Zero. The time that it takes for the real estate, the industrial real estate economy to feel what's happening in the stock market and in the general economy and throughout Europe and every place else where there's trouble is usually 6 months afterwards. So right now we're at least 3 to 4 months away from anybody in industrial saying that there's any trouble. I talk to industrial real estate brokers, I would say probably no less than a half a dozen brokers every day, and there's no let up. We have certain markets here in Chicago where the vacancy rate is as low as 1.5%. And that's unheard of because the normal vacancy rate here is about 8 to 9%. The worst market here, where the vacancy rate is the highest, is 4%. So I have a tenant that is growing out of one of our buildings and they need to move. And I've been looking around for them to try to find a building to buy. There are none. I'm also looking for them as a favor to find something that we don't own that they could move to and I could help them out. There's nothing available. I've never seen a market like this. It's going to get hurt. It has to. Nothing can be this good for this long. And what I see in the rest of the economy, scaring us, scaring me, it's scaring everybody in the industry, but it hasn't hit us.
So how do you insulate yourself? And this gets to this question of debt, something you and I talked about at length in the past. But just tell me, what's your philosophy to debt, and how does that help with any turbulence headed your way or our way in general?
So that is a great question. And my answer to that is leverage to me is equated with gambling. The higher the leverage, the more you're gambling. The lower the leverage, the less you're gambling. And I've studied gambling, and I've watched many developers and syndicators over a period of 40 years through 4 down cycles get into big trouble. People I know who I have tremendous respect for in 2008 went bankrupt. And it's funny because I know their bankruptcy attorney. A few of them had the same attorney, and he called me to see if he could help me. And I said, luckily, no.
Gotta love the lawyers, right? Joel, how are you doing?
So I explained to him that the difference between what we do and what his other clients do is, one of those clients, this guy Bruce, called me up one day and he said, let's have lunch. This was in 2008. And he said, do you know how easy it is for me to borrow? I can borrow 80, 90% on anything, and I'm borrowing everything I can all the way to the top. And I said, Bruce, you're going to get in trouble. We're the same age. You've seen trouble. He says, but it's so tempting. I've got to take it. They're throwing the money at me. And I said, yeah, but when things go bad, there's no margin of error when you have all this debt. And he said, well, what debt level do you have? And I answered 50% loan to value ratio. He said, you're crazy. Who would do that? Why don't you borrow more? You should borrow as much as you can. So a year and a half later, he was in bankruptcy court. And by the way, we were not unscathed. Even at 50% debt, when values went down, 50% debt became 75% debt. And vacancies are still costly. And when the market goes bad, there's more vacancy. So poor Bruce went bankrupt. My other friend Dave went bankrupt. These guys were zillionaires. One built a house near me here in Deerfield that was $5 million with a 6-car garage and an elevator to go upstairs. I don't know. He didn't like walking upstairs. I don't know what it was. And then my other friend built a house on a street, one street over from us, $3.5 million. And I'm thinking, it's a house of cards. These guys are in debt up to their eyeballs. And I learned something that is about me, and it's about my investors. It's about who I deal with. We like extremely low debt, and this is going to sound crazy, or no debt at all. The wealthiest people I know, many of them own properties with no debt, and they don't feel bad about it. They're not thinking, gee, I could get a slightly higher return if I had more debt. They're thinking, I want to protect my wealth. I don't want to have a situation where I have a loss. You can't make up a loss. If you have a little bit of a lower return when things go bad, you're a hero. So lately, I've been buying buildings all cash, no mortgages. And there are a lot of people who don't like it. And there's a number of people who I've gotten to know that not only like it, but call me and say, when's your next deal? I've got to get
right. Exactly. So obviously this has a negative impact on returns and return projections. So I know that you started crowdfunding when you and I met. That was our reason for working together, of course.
Sure.
But so how do you approach investors who are out there being tempted by all these people that's, oh, I got a 20% IRR and it was 70, 80% leverage and etc. What's your conversation with those people like?
I tell my investors who are interested in 20% IRR that I'm the wrong person for them. Because anybody who's projecting a 20% return, which is, as you know, too good to be true almost all the time. If you get lucky, it can work. But luck is a terrible strategy. Stability is a good strategy. Safety is a good strategy. So I tell them, if they're looking for 20% returns, I hope that they do well. And there's a lot of people out there who are promising that kind of return. When they say promise, targeting, it's not a promise, it's a guess. And I tell them also, I don't know if you understand how cap rates work, but I have a friend who only does deals on cap rates. And as cap rates have come down, they started out when I was first in the business, 10 was really easy, a 10 cap. You buy a building for $1 million, you make 100,000, it's a 10% return. Leverage is far more than that. It went down to 9. I couldn't believe it. It went down to 8, 7, 6, 5. In California, it's down to 4 and 3. We don't buy cap rate deals. We can't do that. We buy cash flow deals. So we like to buy properties, and I tell my investors this. We go knock on doors. My son Sam is now working for us, and I send him to industrial parks. And he goes in and talks to the receptionist. If on the window it says no solicitors, to him that's an invitation to walk in. Last week he got attacked by a dog. But we go to these smaller buildings where the owner or the manager actually is accessible when you walk in the front door, and we say, would you like to sell your building? And that's how we pick them up. We pick them up from relationships that we established by being active in the industrial parks.
That's very cool, actually. Let me ask, actually, during these times, Joel, are you seeing a higher inclination of landlords and owners to sell? Are you seeing any changes, actually, in buy-sell environment?
No, the whole market, our whole industrial market is way behind the rest of the economy. It's still difficult. But we buy buildings where we have leases with tenants that we trust. They're manufacturing tenants for the most part, which means they're very sticky. They don't leave. Even if it's a 3-year lease, we look back, well, how long have they been there? We bought a building in the city, in one of the nicer neighborhoods in the city called Sauganash, which if you lived in Chicago, everybody goes, oh, that's where the police and the firemen all live, which is the higher end area of being inside the city limits. And we bought a building there last year. The tenant is called Steiner Industries, and they manufacture a product which is safety equipment for the welding industry, very niche-y. The company was started by this guy, Bob Steiner, when he was in his 30s. And no, he was in his 40s. He had worked for someone in the industry, and he learned the business. They promised him that they would give him a partnership in the business, and then they didn't. So he went out and started his own business. And he started someplace, and he moved again. And the building that they now are in is the third building that he occupied. And in 2016, he sold the business to a company on the London Stock Exchange called Bunzl, B-U-N-Z-L. If you look them up, it's a $9 billion market cap company. That's our tenant. They have 60 employees. They're going no place. We only have a 3-year lease, but they've been there since 1995. They can't move. They can't lose their people. They don't want to move the equipment. So they're sticky. And that's what we find. And the way that we make it work is we buy a property like that for a return on investment. We don't call it a cap rate. It's a return on investment. It's a yield to our investors because it's all cash.
So what kind of yield, what are the yields looking like, Joel? Like what are you offering, not offering, projecting, whatever to your investors?
We won't buy anything unless it's 8. If it's not an 8% yield, we don't want to do it.
And is there upside potential as well on equity growth? You've got these long-term leases with modest bumps along the way. How does equity grow in this tight industrial B&C industrial market?
Historically, which is the only thing I can say, is historically the values of our buildings go up about 4 or 5% a year. So if I look back 20 years, buildings have doubled in value. If I look back 10 years, they've gone up 50%. But if there's a downturn, there may be a number of years where a property doesn't go up at all, or it just stays the same. But because we're yield players and we're just looking to send our investors a cash flow distribution, which by the way are all now by ACH. We don't send checks anymore. We got defrauded. Some people counterfeited checks. They got hold of our checks. We think they were post office employees stealing checks. And literally, I'm not kidding, 20 checks before we saw it, because we check our bank account every so often. These people just got in there fast and wrote checks to themselves. So we don't do distributions by check anymore.
Okay.
From our bank to the investor's bank.
All right.
But yeah, it could end up being zero increase. It could even maybe for a short time go down in value. We're very realistic. We tell people we can't promise you an upside, but we project 14% IRR, which means 8.5 or 9% average return over a 7-year period, let's say, and then maybe an additional 5 or 6% of appreciation if times are good, and maybe 3 or 4% if times are okay, and maybe nothing. But yeah.
Do you look to hold indefinitely, Joel, or do you buy and with the intent of selling at some point? Like, what's the long-term plan typically when you know in your what you do?
Our investors and we like long-term. If we find a great property, when we sell it, how do we replace it with the same kind of tenant and the same kind of income? So what we do for liquidity, if an investor wants to get out, is I'll introduce investor A to investor B. What Mark Roderick, our attorney in Philadelphia, taught us is that's called Rule 144. So if somebody, I'm not a lawyer, but I've got a good one that you introduce. Mark says we can arrange for one investor to buy out another investor, and it's not selling securities. It's just arranging what's called a 144 transfer. So our investors know that if they get in with us, that they can be in for a very long time, or if they want to get out, they call me. I got a call from an investor in Chicago very recently, Ethan, and he said, Joel, I'm just at a point in my life where I'm simplifying my estate, and I've got some properties that I invest in with you. Can you get me out? I said, it would probably take me about a week to get you out. I said, here's how it works. So I called a number of our investors that I know are looking for larger investments or continuing more investments. And the most anxious of them was a fellow named Norm, who was a former dentist in Omaha, Nebraska. I sent Ethan and Norm a 1-page analysis of the building, what I think the value is, what the rent is, what the net operating income is. And I said, Norm, I need you to make Ethan an offer. You guys are going to be on the phone together. I'm happy to be a facilitator on the call, but I don't want to interfere. Norm, you make the offer. Ethan, you decide. They came together. They made a deal. And I have a form that's 1 page, which is an assignment of membership interest. I sent it to both of them, filled out to facilitate, make it easy. And Norm bought out Ethan, and everybody was happy.
Very nice. That's very cool.
Yeah.
Yeah, it's really nice. I love your way of doing business, Joel. I always have. Have you changed your strategy any as the economy is, this year, as we've seen all this turbulence and, black swans flapping across the horizon left and right? What have you changed any?
Yeah, I have deleveraged by selling properties where we had too much debt. or recapitalizing with more equity and paying down debt. We have at the moment 16 properties. We have 3 with 0 debt, and the rest of them have an average loan-to-value ratio under 20%. So what I do is, to prepare for tough times, I really bolster the investments with what I call the safest possible positioning, which is a strong balance sheet, plenty of money in the bank for reserves in case something goes wrong, which oftentimes things go wrong, and very low debt. So the bank is never breathing down our neck.
Now, we started chatting about videos, and I can't remember what got us into that. So it's a bit of a non sequitur to suddenly bring it up now. But you were talking about marketing, and you've been, since we built out this platform for you and with you. You've been doing some marketing. So tell me something about your marketing and your videos and what you're trying to do and your experiences in that regard.
Sure. I hired a video production company because I don't own a camera. I can't go around doing that. And I have nobody with that technical expertise. So I hired a guy who used to be an anchor man in Chicago, who left TV news and became a production facilitator. And he said to me, write a script and I'll edit it. And then I'll bring the cameramen, a regular camera plus a B camera so that we have 2 angles. And we'll go to some of your properties and we'll walk around and talk to your tenants, and you can show your parking lots and your loading docks. And we spent the day just being interviewed and talking freely, including having some of our tenants talk about what they do. And we put together I think it's about a 2.5-minute video. It took us a full day and a half of shooting to get 2.5 minutes. It was so much fun. I came home.
Hollywood.
It was great. It was great. I came home and I said to my wife after that day, this is the most fun day I've ever had in 40 years in real estate.
You know what makes me laugh, though, is that when you and I spend an hour together recording video and we end up with 3 hours of video. The exact opposite.
You know, I've asked you about editing. I know you don't like to edit. You like to let it rip. So if someone says something that they're sorry for, it's out there.
No, we take that stuff out. You know that. We do take the bad stuff out.
Okay. Well, I know that.
So go on. So you're getting some cool vids, and what are you going to do with them?
So I've been sending them. First of all, they're on our website. Second of all, we have established a YouTube channel. And this was all your idea. So I
actually set the YouTube channel up for you.
Yes, you did.
So I'm going to include this in the podcast page. I also need a link to that 2.5-minute video so I can put that up.
Well, I've got many more than that now, because first of all, you made, I think, 40 videos for us, which were really great. I'll tell you a funny story about that. By the way, and I've had the cameraman and the production company help us make other videos. So when we're buying a building, we do a video about that particular property. And we also do them just on philosophically, where my partner and I sit and talk about what we do and how we do it, and talk about our low debt philosophy.
Yeah.
How it's not for everybody. It's one of the best parts of being a video guy is I can distribute it wherever I want to distribute it. So I send it to my existing investors. And it's funny, they send it to their friends and family.
That's interesting, really.
Yeah. So people are interested in hearing what we have to say because they want to get to know us better.
Yeah. And you know that low debt one, you sent me that. It's really good. Really good. It's natural, and it reveals your authentic philosophy to debt, to investing, and it's compelling. It's really interesting.
I've got a great story for you.
Sure.
I have a great story for you on that. I called one of our existing investors who hasn't made an investment with us since 2007. So about 15 years. And I said, I've got this new deal and it's all cash, no mortgage. It's an 8% return. He said, Joel, honestly, at my stage in the game, I'm 82 years old. I'm not that interested in getting involved in something that's somewhat illiquid or more real estate. I'm glad I have what I have with you, but I'm not really that interested. And I said, okay, that's fine. Anytime you want to talk about real estate, if I can answer questions for you and help you with anything, I'm glad to do it. He said, thank you. The next day, it was 24 hours later, because I talked to him at about 10 o'clock in the morning that day. Right around 10 o'clock the next morning, he called me, he said, I'm investing with you. I said, what? He said, yeah, after we hung up, I went to your website and I started watching your videos. And I think I've watched 7 or 8 of them. And I'm sending you $250,000. I'm ready. I said, yesterday you were a no. He said, today I'm a yes. So those videos are really something.
Yeah, it's powerful. It really is. You know what? The beauty of it is it gives your investors and your prospects the opportunity to learn from you, to hear from you, and to research what you're doing anonymously, quietly, without being pitched. They can do it in their own time. It's just so much more comfortable than getting on the phone when you know you're going to be pitched. You can do it quietly in the background and make your decision independently. But you were talking about 200 views of your vids, and you want to get up to 1,000, and you've got some plans and various other things. So what's all that about over there?
Well, right now we don't need any new investors because we don't have enough properties to purchase to satisfy the investor group that we have now. We're sitting on a lot of cash in the bank because we're waiting for the right deal. Mm-hmm. But there will be a time when there will be deals. And when that time comes, I would like to be set up where investors who know who we are ready to go. I want to be able to send out an email saying, hey, we've got this new deal. Let's say it's an 8% return, goes up 3% each year. So 8.1, 8.2, 8.3, good tenant. And I want to be able to syndicate it quickly. So it's really important to set that up. And I believe that the more people we communicate with and tell them our story, the more people are ready for us when we're ready for them. So I want to have it out there where I don't necessarily need anybody to jump in today. In fact, I would have a problem if a bunch of people wanted to jump in today because I'm not comfortable with some of the pricing right now. I think there is going to be a downturn, and I'm sort of waiting it out. We're going to be ready, I'd say, in 2 or 3 months. So for the next 2 or 3 months, my real job is to connect with potential investors. You want to hear the best story ever? This is the best story.
No, I don't.
I got the best. This is amazing. So not only do we send videos, but we have to know who to send them to. Mm-hmm. So we have a list that we subscribe to, which is called Zoom Info. I don't know if you've ever heard of it, but it is the best list in the United States of people who are executives, doctors, lawyers. It's a list of 70 million people, and it gives you all of their information from their email, their phone number, their position, how much their company makes. I don't know where they get all this information, but it's a publicly traded company, and it costs us $20,000 a year to subscribe to their list. And we send out sort of blind emails to people. We've never met them before, and they're kind of cute. It's like, hey, you ever heard of anybody investing with no mortgage for safety of your principal? People think we're idiots, but we do it anyway. You know, that kind of thing where they read it and they say, who would say this? Right. So we have real cute emails. I get a response from a guy from rural Missouri. Never met him, never heard of him. And he said, I got your email and I saw your video. And you piqued my interest. I'm interested in knowing what you do. He was a pretty smart guy. He owns a company. He's got 30 locations, including one in Chicago where he occupies industrial buildings. So he knows about industrial. Mm-hmm. And he asked me if I would give him references. I said, sure. I have 200 investors. I'll give you 25 references. He said, I don't need 25 references.
Right, what am I going to do?
I said, here's what I'm going to do. I'm going to give you all 25, and I'm going to give you the last 4 digits of their phone number so that you know when you pick any one of those 25, I'm not just sending you my 2 or 3 people that I call up and say, hey, this guy's going to call you. You pick, and I will then give you the whole phone number of the person and their last name. He called a few of them, and he said he had checked me out by talking to them, and he was very comfortable. He said, but I don't like to invest with people I haven't met. I said, we should meet. He said, coincidentally, my wife and I are going to be at a board meeting in Chicago in 2.5 weeks. I said, I have an idea. How about a blind date, a couple blind date where my wife and I will meet with you and your wife and go out to dinner? He said, I've never heard of anything like that. I said, I've never even heard the term couple blind date. I just made it up. He said, well, that might be fun. I said, so what time is your flight on the day you're leaving? He said, 9 p.m. I said, where are you staying? Hyatt Regency, Chicago. So Stacy and I took a flyer. We went down and picked them up at their hotel. We took them to Greektown, to the Greek Isles restaurant. We hit it off. We love these people. A lot of things in common. He's younger, but they have 3 kids like we do. He's got kids in the business like we do. He built a business from almost nothing like I did. There's sort of a religious aspect to who they are, and we're different religions. They're Catholic, we're Jewish. We hit it off and talked about that. The whole thing just went so nicely. And then I took them for a ride around town and showed them on the way to the airport a number of our buildings. And we went to the airport and dropped them off, and we literally hugged. I mean, we shook hands and hugged. We have these new friends. And he said, I'm in. He says, count me in. I checked you out. We've gotten to know each other. Let's do it. So he invested $250,000 in my deal at that time. This was a couple of months ago. And I'm sending him emails saying, hey, I just sent you your distribution. And we're now email buddies. Investors like to know who they're getting in with. They want to be able to trust. And I trust him, and he and his wife trust me.
Very nice. That's a lovely story, Joel. Yeah. So let's wrap up with a couple of questions, and I've got 3 rapid fire questions, right? 3 rapid fire. But first, a couple of questions, and you'll be able to guess what the second of these 2 is. If the first one is, what are the biggest challenges that you're facing at the moment, and do you anticipate facing going into 23?
It's really hard to find deals to buy. Everybody has piled into industrial. Seems like people who never heard of it before are now industrial players and
experts, right?
Experts. So we're competing against everybody we've never heard of. And that means that prices are being bid up. It's hard just to find a deal. As I said, my son goes canvassing door to door, and we used to find 1 out of every 50 would say, yes, we might sell. Now it's 1 out of every 150. It's triple as hard to find deals.
And so the flip side of that question is, what are the opportunities? Do you see that changing, do you think, over the next few months?
I do. I think there are going to be some deals. They may not come till early or mid 23, but they're coming. It's going to happen.
What's going to drive that in the B and C industrial space?
I think every manufacturer out there and distributor that occupies buildings like ours is affected by what the Fed does. You know, the Fed is very powerful in terms of this economy, and as they do this quantitative tightening, and they do whatever kind of interest rate increases that they need to do to slow the economy down, our kind of tenants are going to have issues with renewing their lines of credit at banks, their loans.
Right.
and they're going to end up paying more than they thought they were going to pay for it. They made assumptions that interest rates would be at 1 or 2% for a really long time, and now they're at
Now they're not. Right. Exactly.
Yeah. So I think that they're going to get squeezed, and there's one other thing which happened. The inventory level has swelled dramatically during COVID, and especially recently. People buy way more product than they need because they were afraid of supply chain disruption and not being able to get product. So they overbought. Warehouses are full. But they're more full than they should be. At equilibrium, there should be an 8% vacancy factor. Right now, it's 4 or less. And that's because they have all this stuff in racks, in pallets and racks. And that's going to go away. They've overbought, and they're going to be stuck with excess capacity in terms of their products. And when that happens, they're going to start letting people go, and they're going to start having less space needs. And it's going to be a problem. And that's where the opportunities will come in for us to help them by buying their building and leasing them back. That's called sale leaseback. And we do that often.
Very nice, Joel. Always a pleasure. Let me ask you 3 sign-off questions, if you like, rapid fire questions. So the first of 3, what are I might have asked you this before, but anyway, here we are again. What are your personal daily habits that keep you productive and successful?
Sure. I keep a list. I have a book where I keep a list. I'm a list maker. And I try to keep my list down to 40 things that I have to worry about or think about or act on. So one thing is every day I go through my list and I cross off what's been accomplished and I add what needs to be added. That's the very most important thing that I do. Secondly, I make a real effort to get on the telephone with clients and investors and tenants, because the personal touch is missing today. Too many people are texting and emailing. And even though that seems like a personal relationship, it isn't. A personal relationship has voice tone, and people understand how much you care about them when you let them know. And that phone call matters. So every day I at least do 10 phone calls to people. If I do 20, it's not too much.
Second question of 3. What's been the hardest lesson you've learned in real estate?
Leverage in bad times is death. And I can't take it. I cannot do that. I cannot. At this point, I'm 63 years old. I have 200 investors. I don't want anyone losing money on my watch. And we had deals in 2008 that did not work out well. We've had 7 out of about 100 properties that we bought. We've had 7 significant losers. And I don't want there to be 8 significant losers. Can't help it if something goes wrong out of our control. But if we have very little debt, the losses are minimized. It's mitigated.
So the last question, what advice would you give or do you give to passive investors thinking of, I would say today, looking for a safe haven, right, in these turbulent times? What advice do you give them?
First of all, cash, have lots of cash. Be ready, dry powder. I do not have any stocks anymore. I have a few bonds, and we're keeping a lot of cash reserves in our business accounts and in our personal accounts. I think that that's a big one. I think there's no right answer to that. I can't come up with a perfect answer, but just be really careful. Watch The Economists. There's a guy on who does an interview show by the name of Adam Taggart. It's called Wealthy On. I don't know if you've seen him. You'd love this guy. And you watch the economic trends and can make some decisions based on the experts that he interviews. It's outstanding. So just being up on what's happening in the world and making sure that I don't bury my head in the sand and pretend that bad things are not happening.
Not happening, right. Joel Friedland, founder, CEO, COO, I don't know, everything anyway over there at Brit Properties. Super nice guy. Thanks so much, truly, for being on my podcast today. It's always a pleasure.
Thank you. Take care, Adam.
That was Joel Friedland, principal at Brit Properties in Chicago. To find out more about Joel and Brit Properties, go to the podcast page at gowercrowd.com. And while you're there, be sure to subscribe to the Gower Crowd free weekly newsletter. It's the only one that you will find anywhere that is exclusively dedicated to real estate crowdfunding and syndication news and updates, where you'll get information and resources that are tangible you can use immediately. All there at gowercrowd.com. Joel, thanks so much for joining me today. It's always so good to see you and to learning about your investment philosophy and about Brit Properties. Thank you so much. And of course, you too, dear listener, thanks for joining us today. Without you, we would be nowhere. That's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.